Tfsa versus RSP. Are they the same? Are they different? Is one better for you? I'm Benny Zanetti, Certified Financial Planner, and it's time to dig a little bit deeper. Both TFSAs and RSPs are a great way to save for retirement, but that's where the similarities end. The way they're treated by the CRA in terms of taxation is very different, and not knowing those differences can end up costing you a lot. Most of us know that contributions to an RSP trigger a tax receipt, which reduces our taxes payable and usually results in a tax refund. What's important to know is that when we withdraw from an RSP, it's considered income and is taxed as such. Another thing to note is that Canada uses what's called a progressive tax system. The more money you make, the more income you report, the higher your marginal tax rate. With a TFSA, contributions have no tax advantage. There's no refund, but when we withdraw from a TFSA, it's not considered income and it does not affect our marginal tax rate. So why is this important? How can it help us? Let's look at an example. Let's assume that I decide that I can get by on $70,000 a year gross income in retirement. In order to get that income, I'm going to withdraw from my RSP, my CPP, my OAS, and my company pension, all of which are taxable. Now let's assume that I want to purchase a car that year, and the total cost is going to be $50,000. Because I didn't plan well, I'm going to pull the money out of my RSP. So in order to pay for the car, my income, and all the taxes owing, I'm going to have to withdraw about $148,000. Now let's assume that I planned well, so I have a significant balance in my TFSA to purchase the car, and that's where I pull the $50,000 from. So in order to achieve my income, the purchase of the car, and all of the applicable taxes, I'm only going to have to come up with $120,000. That's a savings of $28,000. Now let's muddy the waters a little bit. I mentioned this thing called OAS. That's a benefit that most Canadians qualify for, but it's what they call needs-based. If you don't need it, you don't get it. And they determine this by using a procedure that's commonly known as clawback, and it works like this. If you have reported income up to about $76,000 a year, you qualify to receive 100% of the benefit. For every dollar you earn over $76,000 a year, the benefit is clawed back slightly until about $123,000, where the benefit is gone altogether. So you see, our scenario with the TFSA not only saved us money on taxes, but also preserved the OAS that would have otherwise been almost completely depleted. Now I realize that there are hundreds of things that could change this scenario. How much you were making while you were contributing, whether you take your CPP at 60 or 65 or 70, whether you're married, whether you're single, even taking a 0% loan instead of taking the money out of your TFSA. These things are all contributing factors. But the point of this video is not to make a financial professional of you. It's to make you understand that the small things you do today can have a big difference on what you can and can't do tomorrow. I hope this helps clear things up. If you need more information, feel free to email me. That's on my landing page of my website. Until then, stay safe, stay happy.